Okay, let's dive into a fascinating and, let's be honest, a pretty intimidating topic: trying to spot a market crash before it happens. I mean, is it even possible? Can you really find a reliable crystal ball in the chaos of the financial world?
So here's how we're going to tackle this. First, we'll frame the problem itself. Then, we'll see what history tells us by digging into a massive academic study. After that, we'll zoom in on a huge risk that big institutions are watching right now, listen in on what retail investors are saying, and then, try to tie it all together.
This is the big question, isn't it? It's what keeps everyone up at night, from central bankers who are trying to manage entire economies, all the way down to day traders just trying to manage their own accounts. So, let's explore the different tools they're all using to try and find an answer.
Right, the financial world is absolutely flooded with data, charts, opinions, you name it. But the real challenge, the billion-dollar question, is how do you separate the few really meaningful signals from all that overwhelming everyday noise?
So, we're going to go on a little journey. We'll start in the ivory towers of academia, swing through the boardrooms of central banks, and land right on the digital trading floors of Reddit to see how all these different people, the experts and the amateurs, try to do exactly that.
All right, first up on our journey, researchers at the Bank of England used machine learning to sift through more than a century of financial data from all over the developed world. Their goal? To find the most reliable warning signs, the ones that have truly stood the test of time.
And when I say they looked at a lot of history, I mean it. The span that they covered is just massive. We're talking about a data set that includes everything, from panics in the late 1800s to the Great Depression, all the way up to the 2008 global financial crisis. They wanted to find the patterns that show up no matter what decade it is. So, what's the big reveal? After churning through all that data, two characters consistently show up right before the trouble starts. First, you've got rapid credit growth. Basically, those times when borrowing gets a little too easy, what the researchers call credit booms gone wrong. And second, the behavior of the yield curve, which is really just a fancy snapshot of interest rates.
So, what on earth is a yield curve inversion? Well, normally, you get paid more interest for locking your money up for a longer time, right? An inversion is when that whole thing flips on its head. It's when the market is so nervous about the near future that it demands a higher interest rate for short-term loans than for long-term ones. It's a classic, though not flawless, recession alarm bell.
And boom, here's our first major clash. While the academics are looking at a century of data and saying, hey, this is a really reliable signal, a lot of modern traders on the front lines are saying, nope, not anymore. They believe central banks have intervened so much that the old signals are broken. It's a perfect example of historical data meeting a very messy modern reality.
Okay, so let's take that academic theory and see how it holds up right now. We're going to look at a major risk factor that the European Central Bank has its eyes on: this massive pile of debt sitting in the U.S. corporate bond market. For a long time, the market just seemed to ignore rising interest rates. It was kind of weirdly calm. But that calm has started to crack. The spreads, that's the extra interest companies pay on their bonds compared to super safe government debt, have started getting wider. That's a huge sign of nervousness, and it's pointing to two major risks hiding just beneath the surface. You see, the problem is a 1-2 punch. First, you've got this giant wall of debt that's about to mature. It needs to be paid back soon. And second, almost all of that debt was issued back when interest rates were basically zero. So now companies have to replace cheap debt with much, much more expensive debt. And the scale here is just mind-boggling. We're talking about over $640 billion that needs to be refinanced in the rest of 2025 alone. And then there's almost another $1 trillion coming due right after that in 2026.
And this is where the rubber really meets the road. According to simulations run by the ECB, a full 85% of all that maturing debt will have to be refinanced at higher interest rates. You can see how that would start to squeeze company profits, and that's the core of the risk.
And if you look at this chart, you can see just how severe that shock could be. About a quarter of all this debt could see its interest rate jump by more than 2 full percentage points. For some businesses, a hit like that, well, it could be a crippling blow. Okay, so we've had the long-term historical view and the medium-term institutional risk. Now, let's switch gears completely. Let's jump into the chaotic digital public square. Places like Reddit, where everyday investors are trying to figure all this out in real time. What you're seeing here is just this powerful mix of fear and speculation. But notice the focus. It all comes down to interest rates.
And this deep-seated belief that the market is some kind of artificial Ponzi scheme being held up by the Federal Reserve.
And you see it again and again. The conversations always circle back to the same things. What is the Fed going to do next? Is this whole market a bubble? And everyone is watching volatility indicators like the VIX, the so-called fear index, for any sudden spikes. And of course, there's a huge suspicion about all the money printing.
Now, this is where it gets really fascinating. That sentiment right there actually echoes what the academics were saying about credit. It's the same core idea, just seen through a totally different lens. What an academic calls a credit boom, a retail trader calls artificial liquidity being pumped into the system by the Fed. Same ingredient, different interpretation.
So where does that leave us? We've got the long-term academic view from 150 years of data. We've got the immediate institutional risk focused on corporate balance sheets. And we have the real-time emotionally charged retail sentiment. So how in the world do we fit them all together?
This table, I think, just brilliantly summarizes our whole journey. It shows how each group is looking at pretty much the same ingredients, things like credit and interest rates, but they come to wildly different conclusions about what it all means. For an academic, the yield curve is a reliable signal. For a retail trader, it's manipulated. For an institution, it's just one piece of data in a giant risk model.
And that's really the heart of it, isn't it? There's no single magic bullet. To get the full picture, you have to understand the slow-moving historical signals, the immediate balance sheet risks that institutions obsess over, and the powerful, often totally chaotic, role of human emotion that drives the market day to day.
And this is why it all matters so much. Those academic signals, like an inverted yield curve, they can take years to actually play out. But market sentiment, that can flip on a dime based on a single headline. And here's the real kicker. Both of them can be right, just at different times. And that's what makes this all so incredibly difficult. Which leaves us with one last, kind of philosophical thought. Maybe the goal isn't really to find some perfect predictor that tells us exactly what's going to happen next. Maybe the real goal is just to appreciate all these complex, competing forces at play, and to simply be prepared for a whole range of possible futures.